So 2025 was, well, it was a confusing year, right? It felt like we were all watching this giant game of financial chicken. And now, stepping into 2026, it feels like the chaos is only cranking up. So today, we're going to break down the 3 big scenarios that could really define the year ahead, starting with the massive tug-of-war that's got everyone so divided.
And really, this is what it all boils down to. On one side, you've got the bears, just screaming from the rooftops that a recession is long overdue. And on the other side, you've got the bulls, chanting AI stocks to the moon. This is the exact battle that defined last year, and believe me, it is setting the stage for everything that comes next.
All right, so let's start with the bear case. Why do the pessimists think this whole thing is a giant bubble just waiting to pop? Well, their argument really stands on 2 main pillars. And the first one is all about valuations that have gone, frankly, completely stratospheric, especially in the tech world.
Just take a look at this. Palantir, a huge name in AI, is trading at around 400 times its earnings. Now, what does that even mean? It means for every single dollar the company actually makes in profit, investors are willing to pay $400 for its stock. You know, at that point, you're not really buying fundamentals. You're basically just buying hope.
And this isn't some isolated case. Here's Datadog, clocking in at over 430 times earnings. I mean, these are the kinds of numbers that have the bears shouting that we've just gotten way, way ahead of ourselves on this whole AI story.
But here's where it gets really interesting. This excitement has dragged the entire market up with it. The S&P 500, the big benchmark for the whole market, is now trading at nearly 31 times earnings. So, is that a big deal? What does that number actually mean in context?
Well, this slide shows you exactly why people are worried. The long-term historical average PE ratio for the S&P 500 is somewhere around 16. We are currently trading at almost double that. The bears are arguing that if things just go back to normal, back to the average, then the entire market could take a massive hit. Okay, so that brings us to the second pillar of the bear case, concentration. See, the market isn't rising on some big, broad wave. Nope, it's being dragged higher by just a handful of absolutely massive tech stocks, the ones we call the Magnificent Seven. Apple, Microsoft, Nvidia, those guys. Right now, those 7 companies make up more than a third of the entire S&P 500.
So how did we get here? Well, it's fueled by this fascinating thing called a passive investing feedback loop. Let's walk through it. First, the big tech stocks get even bigger. As they do, their weight in the major indexes, like the S&P 500, goes up. So then, all the new money that you and I put into our 401ks, into ETFs and index funds, it automatically flows toward those bigger companies, which of course pushes their prices even higher. It's a cycle that works like an absolute dream until it doesn't.
So you might be thinking, wow, that bear case sounds pretty solid. But here's the thing. It has one massive weakness: timing. The famous economist John Maynard Keynes put it perfectly. Being right too early is basically the same thing as being wrong. And that brings us to the complete other side of the argument.
Okay, enough for the doom and gloom. Let's flip the script and look at the bull case. What if the market doesn't care about historical averages? What if this thing just keeps ripping higher? Well, the optimists are looking at 2 incredibly powerful tailwinds that they believe could keep this party going strong.
And those 2 tailwinds are monetary policy and fiscal policy. Okay, in simple terms, that means the central bank is making money cheap and the government is pumping tons of cash into the economy. Let's break down exactly what that means.
First up, monetary policy. The Fed started cutting interest rates at the end of 2025, and pretty much everyone expects more cuts to come. This is the absolute core of the bull argument. It's a simple formula, really. Lower rates mean cheaper capital for companies to borrow and expand. That supports higher stock prices. It's like pouring gasoline on the fire for riskier assets.
The other half of this equation is fiscal policy. The U.S. government is running a budget deficit of over $1 trillion a year. Now look, that is a huge problem for the long term, for sure. But in the short term, it's like a shot of pure adrenaline for the economy. All that spending keeps consumers buying things and keeps companies' revenues up, which keeps the whole economic engine humming along.
Okay, so you've got the super bullish case and the super bearish case. But here's the thing about markets. When 2 massive forces like these collide, things rarely move in a nice, clean line. And that brings us to our third possibility, the uncomfortable gray area. It's the one outcome that almost nobody is talking about, probably because huge crashes and epic rallies just make for way better headlines.
And that scenario is this:
A long, choppy, sideways market. No glorious rally to the moon, no dramatic crash and burn. It's a market where the headlines flip from bullish to bearish every couple of weeks, and there's just no clear direction. It's a grind.
And let me tell you, these can be the absolute hardest markets to survive. Every little rally dies just as you start to feel confident again. Every dip feels terrifying, but it never goes low enough to be a real bargain. It's a market where your money just seems to spin its wheels, rotating from one thing to the next, and impatience can absolutely destroy your portfolio because every single move you make feels wrong.
So where does all this leave us heading into 2026? Look, the goal here was never to give you a magic crystal ball. It's to arm you with the different frameworks, the different arguments that are all at play right now. Because understanding the forces that are pushing for a crash, a rally, or just a long grind, that is the first step to be able to navigate whatever actually comes next.
So after all that, I'm going to turn the question over to you. You've heard the case for a major downturn, you've heard the case for a continued rally, and you've heard about the potential for that long, frustrating sideways grind. What do you think happens next? Which one of those scenarios feels most likely to you? Because whatever the answer is, it's probably going to define the year ahead.